Hey everyone, and welcome back to another episode of Data Driven Value, where we show you the tools and we teach you the skills to help you take your financial freedom into your own hands. So we're going to jump into things today. We're going to do a little update kind of on a macroeconomic conditions here, just around this new news that we got yesterday. So we saw here, obviously, Trump is set to impose new tariffs on major U.S. trading partners. So I don't know if you noticed or saw in the news, but obviously we see Trump here plan to impose tariffs on China, Canada, and Mexico. This was dated yesterday, so those do come in effect today. Goods from China would be subject to a 10% tariff, and Mexico and Canadian goods would be subject to a 25% tariff. So, kind of what we're going to talk about here is basically tariffs, the use of tariffs, kind of why the U.S. is looking at kind of utilizing tariffs as kind of a protectionist policy to try and boost their domestic economy. That being said, I do think there are a lot of ramifications with this kind of increase in tariffs. That's what we're going to dive into today. We're going to look at kind of the global macroeconomic effect of these kinds of tariffs, what they can lead to. So you could lead to a trade war in the future. We're going to touch on that, as well as look at some past historic examples, kind of what we can expect if we are to go through a bit of a trade war in the future. There has been a lot of bullish advancements and bullish news about markets, about crypto. That being said, to be an informed investor, we really need to look at both sides of the argument. So we need to look at the most bullish argument and we need to look at the most bearish argument. I argue that there are enough worrying economic factors in the economy today to actually warrant a little bit of not negativity or pessimism, but just approach markets from a cautiously optimistic standpoint. Just recognize that a lot of assets are very inflated right now in terms of their valuations. And then just with kind of more uncertainty around this in terms of the macroeconomic policies going forward and kind of how these countries are going to retaliate, we're going to dive into that and see if we can't kind of figure out what kind of just ramifications we might see in the near term as a result of a continued kind of threat of tariffs or the implementation of tariffs. So just moving on quickly, we're going to see here, just previously we saw this kind of trade war threat here with Colombia. Obviously, I touched on it on a prior video. We just see Trump. He's essentially going to try and strong man everyone into doing what he wants. So basically, anyone who doesn't agree with what Trump wants for the company or for their administration, he's just going to threaten them with tariffs. So obviously, we saw here that Colombia was the first to get threatened with tariffs, and then China, Canada, and Mexico were the first for him to actually follow through and impose those tariffs. But yeah, we obviously see him threatening it on Colombia. And then we saw kind of some other South American companies really expressing or condemning those actions. So Brazil here. So it is interesting to note if Trump and his administration do start imposing tariffs on some of these South American companies or these Latin American companies, we'll see what their retaliation is. We could see a lot of South American or Latin American companies kind of, or not companies, countries band together and really kind of try and stick it back to Trump on that front. Obviously, they're not just going to bend over and just be subject to these tariffs. They're going to try and do everything they can to remain competitive. So we do see here, obviously, it's not the first time that he's threatened this, but it is the first time of this current administration's term that he's imposed these tariffs. So we'll follow that going forward. Kind of just diving in here. We look at tariff retaliation and how it threatens American wallets. So I'm going to talk today. Trump's basically been saying that all these tariffs are going to be good for the American economy and that it's going to increase domestic production as well as lower costs for consumers. I argue that the history and the data actually says the exact opposite. So what you'll actually see is basically an increased cost of goods due to the rise of import costs. Most of the time, manufacturers and importers, they shoulder this onto the consumer. They're not the ones footing the cost or the additional costs. So at the end of the day, you actually end up paying more as a consumer, and we'll get more into that as we get through this article. But obviously we see here, Americans in general have paid increasing prices on many goods from China. So this is also from November 19th. It is a little bit older, so it's still very relevant. We're just looking at past historic examples kind of similar situations that we found ourselves in. So we see here, yeah, Americans in general have paid increasing prices on goods from China. Many companies have found alternative sources, though prices have not decreased. Everyone pays more when tariffs are introduced because the importers pass the price along to consumers. That's what I was saying above. Obviously, the importers, they know that we need the products that they're importing, and if you need the product that's being imported, you're going to have to pay that increased price. And as the consumer, even the same with inflation and as well as during COVID, when there was all that money printing, it really caused inflation to skyrocket. It was mostly the consumer that shouldered the burden of that additional cost. We saw inflation go crazy, and we were paying substantially more for all the same stuff we were previously buying. So again, a lot of this, it's advertised to help the people, but at the end of the day, it actually affects the consumers negatively. It doesn't seem to affect the businesses as negatively, especially because you're boosting domestic business. But as we said, those businesses are not shouldering that increase in costs. They're passing it on to the consumer. So you're paying more for all the same products as a result of these tariffs. So you also see here, there's concerns that the tariffs will not be able to bring in enough revenue to offset the loss of income taxes and other projects. So that's something Trump is claiming he'll be able to do. We see here clausing here. So this is a previous Treasury Deputy Assistant Secretary for Tax Analysis during the Biden administration, said tariffs will not be able to bring in the required revenue to offset the TCJA with a 10% tariff on all imports and 50% on China. So yeah, it's not going to be enough, especially since the U.S. is the main importer of Chinese goods in terms of their trade deficits. So China's the worst. It's interesting to see they actually put a smaller tariff on China than they did on Canada and Mexico. But yeah, we obviously see here the United States would only receive around $2.7 trillion in revenue over 10 years. And then we see that 10% increase in tariff could raise up to 2.5 trillion. That amount would be reduced to 2 trillion when you account for the dynamic economic effects of resulting market shifts. And then we also see 60% tariff on Chinese goods could bring in up to 2.4 trillion, but it would ultimately yield a deficit of 300 billion after calculating dynamic economic effects. So essentially, the economic effects of these tariffs actually offsets the positive effects just based on these historic examples and this report from the federal budget here, the Committee for a Responsible Federal Budget. So we do see here, obviously, at the end of the day, this isn't good for the American consumer here. Then coming down, we see increased consumer effects. So tariffs would reduce after-tax incomes by 3.5% for those in the bottom half of income distribution and cost a typical household over $1,700 in increased taxes each year. So that goes pretty much exactly against what Trump is saying that these tariffs are going to do. Traditionally, they have reduced after-tax incomes by 3.5%, so you're actually making less money, and you're also paying more in taxes as a result of these tariffs and this kind of report that was issued here. We see here that same institute found that the typical American household costs would increase by $2,600 a year if 60% tariffs are imposed on Chinese goods. But so this is where I talk about, it says the top 1% would experience net gains in income because their losses from tariffs are more than offset by Trump's proposed tax cuts. So this is what I talk about, how it favors the 1% again. It's all favoring the richest people in the economy. You see that most of the people are going to be in that lower tax bracket in terms of income. Most people, bottom half of the economic ladder, they're not reaping the benefits of these. We obviously see that the businesses benefit from proposed tax cuts, as well as additional kind of, if they're US based companies, really benefiting from that increased market presence, as well as kind of support from the government there. But again, as we talked about, the additional costs get passed down to the consumer. So again, the top 1% gain more value in their net assets, and the typical consumer hurts because they have to pay more in taxes. Their income is actually less as an effect of it when you factor in kind of the the macroeconomic effects of those. And then we see here the cost of Trump's proposed new tariffs will be nearly 5 times of those caused by the tariff shock in 2019, likely costing consumers around $500 billion per year. So I don't really see the kind of end game here. The way I think of it, Trump is a businessman and he's invested in all these domestic businesses and he wants to see his net worth go up. He is in the top 1%. I mean, maybe not literally in terms of actual net worth, but I consider him being up there among the elite who really kind of benefit from this further concentration of wealth. We also saw that this is really going to hurt small businesses and consumers. That's the same thing we saw in COVID. We saw the small businesses and the consumers being negatively affected, while we saw these major corporations just make out with trillions of more dollars that they didn't have before. So again, this just looks like a further consolidation of wealth and power, in my opinion. And at the end of the day, the everyday person kind of ends up footing the bill, or kind of reaping the negative reward or the negative kind of effects of these kind of policies. So not really. We do see here, obviously, though, this can cause trade disputes and retaliation. So during Trump's first term, he placed tariffs 25% on imported steel and 10% on imported aluminum from Canada, European Union, and Mexico. So all these countries and the European Union impose retaliatory measures on items like agricultural products, whiskey, bourbon, alcohol, Harley Davidson. So these are kind of just random little things here. But again, you can see how when they impose these tariffs, all the countries that are affected by them, they retaliate by putting in tariffs of their own. That's when we get into a trade war, and that's when things start to look a little bit more bleak for the consumers at the end of the day. So we see here, China's retaliatory tariff list could target items such as soybeans and other agricultural products. In 2022, the United States exported 36.4 billion in agricultural products to China. China is the world's largest soybean importer, accounting for 60% of global trade and half of the U.S. soybean export value. So they're really playing with fire, because half of the value that China imports, or sorry, half of the value that the U.S. exports in terms of soybeans is being purchased by China. So if we're throwing tariffs on them, and then China puts tariffs on our soybeans, and then kind of like we just, no one wins at the end of the day. We're just threatening each other, and again, it's the consumer that kind of foots the bill when it comes down to it. So we see here, obviously, back then, the impact of a China-U.S. trade war, which could shift much of China's agricultural imports to Argentina or Brazil, would be extremely difficult for American growers to reclaim that lost market share. So again, saying that these tariffs are only going to positively impact American businesses is kind of a lie based on all the studies, reports, and the historical data. So just pay attention to that. We do see there's a reason that in 1930 the Smoot-Hawley Tariff Act was criticized by all prominent economists. It was the largest tariff hike in U.S. history and caused significant damage to the U.S. economy. A lot of people are kind of contributing that as well as a major contributor to the Great Depression that followed. So we'll get into more kind of the history around trade wars here. So obviously, trade wars, history, pros, cons, and kind of a U.S.-China example we'll touch on. So obviously, key takeaways: a trade war occurs when a country retaliates against another by raising import tariffs. Trade wars are a side effect of protectionist policies and are controversial. Advocates say trade wars protect national interests and provide advantages to domestic business, and critics of trade wars claim they ultimately hurt local companies, consumers, and economies. So all things we just touched on. We're just going to get a little bit more in depth here and just get through this article. So trade wars are usually considered a side effect of protectionism. So protectionism is essentially the government trying to enact policies that restrict international trade and promote domestic business. Generally, they're going to undertake these actions to shield their domestic businesses and jobs from foreign competition. It can also be used to balance trade deficits. So that's what they're doing in this kind of right here. They want to really balance their trade deficits. That being said, I kind of argue that the U.S. does not have the kind of the infrastructure to be able to produce those same goods at the same cost. That's where you really kind of see that even if they put these tariffs in, people aren't going to be able to afford the same products they were previously buying, and now they don't have kind of a competitive alternative. So it's kind of interesting. We will see what happens going forward, but kind of continuing on, we do see here the growth of damaging effects. So in an era of global trade, a trade war can become very damaging to consumers and businesses of both or multiple nations, and the contagion can grow outside of just those economies, kind of into more of a global scale. That's what I'm kind of talking about today. We do obviously see it's a much more interconnected world in terms of trade. So really important, and we will be watching this very closely and kind of see how it affects different economies here. We see the trade war begins in one sector, grows to affect other sectors, and likewise it can also grow to affect other countries. We do see here other non-tariffs protectionist policies can be implemented. So like placing a cap on import quotas, setting clear product standards, or implementing government subsidies for processes to deter outsourcing. So rather than going this route and kind of, still maintaining some of the kind of more favorable trade policies with other economies, they kind of just went with the tariffs, and it doesn't seem like he actually has any kind of plan. He says he's not interested in negotiating. He's not interested in removing them for any reason. He's kind of just doing his thing. But again, I don't think Trump has really thought this through, or if he has, he doesn't care. Again, he is a businessman. He is an investor. He wants to see his investments go up, and if he can kind of make it skew the people to believing that this is actually going to be beneficial for their own personal savings and bank accounts, it's kind of a win for him. But again, that's why we just look at the data. We don't listen to what politicians tell us at face value. If there's anything I've learned in the years of kind of following politics and investment, is that they're just going to lie to you over and over and over. They're going to tell you what they want, and then it's going to be a lie. So we just look at the data. The data doesn't lie, so that's what we have, and that's what we're going by. We see here the history of trade wars. They're not an invention of modern society. They've actually been going on for technically thousands of years in a way. We see such battles have been going as long as nations have conducted trade. There has been trade wars. So one of the most, or the first and kind of most prominent ones here, was the British Empire had a long history of trade battles. Obviously, one was with China in the 19th century. This is around kind of the Opium Wars. They did have attempts to settle the conflict and failed, and it actually led to the Chinese emperor sending in troops. So you can see in this instance, this trade war actually kind of escalated to a physical conflict. That being said, that was in the 19th century, so quite a bit older. I don't expect that to happen again. What I'm alluding to, or what I want to kind of show you here, is this U.S.-Europe, what we have here. So in 1930, the United States enacted the Smoot-Hawley Tariff Act, raising tariffs to protect American farmers from European agricultural products. This act increased hefty import duties to almost 40%. Several nations retaliated by imposing their own higher tariffs, and global trade declined worldwide. So we see here, America entered the Great Depression, which was aided greatly by disastrous trade policies. That's exactly what I'm talking about. Began to pass several acts to reduce trade barriers, including the Reciprocal Trade Agreements Act. So you see here, they imported all these tariffs, and it just bit them in the butt, did the exact opposite of what they wanted, went into a Great Depression, largely aided again by these disastrous trade policies, and ultimately had to backpedal on those policies and come up with a Reciprocal Trade Agreement Act. So yeah, you can see how here again, just really hurting the consumer at the end of the day. We do see here, beginning in January 2018, Trump also imposed a series of tariffs on everything from steel and aluminum to solar panels, washing machines. Some of these effects impacted goods from the UE and Canada, as well as China and Mexico. Canada retaliated by imposing a series of temporary duties on American steel and other products. The UE imposed tariffs on American agricultural imports and other products. And by May 2019, tariffs on Chinese imports impacted nearly $200 billion of imports. So you see, this doesn't go without retaliation. They're not just going to sit there and let them kind of be bullied by Trump and the administration. They're going to retaliate in the way that they see fit. And unfortunately, that just leads to these trade wars. And we see with all trade wars, China retaliated and imposed stiff duties on American imports. And we see here, a study by the IMF found that U.S. importers of goods primarily shouldered the cost of tariffs on Chinese goods. Again, that's what I'm trying to get into your guys' heads here, is that the consumers are going to foot the costs here. So the businesses, it's good for them. It's going to increase kind of their presence in the domestic market. But again, you're the one footing the cost of the increased prices here, and then again passed on to the consumer in the form of higher prices. So getting down, we'll look at some advantages and disadvantages of a trade war. So kind of see here, the idea is to throw more business toward the domestic producers, which ultimately creates more American employment. That being said, if you don't have the producers with the supply chains ready to actually step in and replace the amount of goods that are being kind of tariffed and no longer imported, then you aren't meeting the same demand. And those people the people who rely on those imports, or maybe they need those imports, they have to pay that increased cost of goods regardless, because you don't have the necessary infrastructure or the necessary supply chains to kind of really step in and fill that void in terms of manufacturing. So obviously, we see in terms of Canada, about 50% of the yearly trade deficit is crude oil or refined oil. So that being said, we're providing a lot of oil to the states. If it made more economic sense to produce this oil within the states, why aren't they doing it right now? It makes no sense to me. They don't have the same facilities, they don't have the same infrastructure to meet that requirement. They're obviously importing all these goods for a reason because they need them. So again, it's just going to be you as the American paying more for the goods that you need. So it's just not good as a consumer, but it can be beneficial to certain domestic businesses. That being said, it does have an effect on the global economic conditions, which affects markets, and therefore it can affect valuations of these companies as well. It's kind of like when you think of things. Would you rather have a small piece or a big piece of a small pie, or a small piece of a big pie? At the end of the day, it's negligible which you choose. That being said, you're much better off kind of adopting that global trade standard, really building these relationships and thriving off the advantages and disadvantages of all the other nations. So obviously, moving down here, though, we see that proponents believe that painful tariffs and trade wars may be the only effective way to deal with a nation that continues unfair, unethical trading policies. So that's kind of what I'm worried about, is enough nations kind of just say enough is enough. We're sick of Trump threatening tariffs on every single person who doesn't follow through with his wishes, and they all kind of band together in a bit of a trade war against the United States. They're not making many friends, especially with their neighboring allies. And that being said, China, obviously a major exporter of goods globally. The more market share they can capture, the happier they're going to be, I'm sure. So, yeah, I'm sure they are happy that the U.S. is kind of going this way, because it's going to likely increase their global market share. And we see here, these are the disadvantages. So critics argue that protectionism often hurts the people it's intended to protect. We talked about that. It chokes off markets, slows economic growth and cultural exchange. We also see here consumers have less choice in the marketplace, face shortages if there's no ready domestic substitute for imported goods. So that's what I talked about, not having the supply chains or the facilities in place to immediately kind of fill that void, replace those goods. That leads to shortages, increases in prices. Yeah, going on, we see here having to pay more for raw materials hurts manufacturer profit margins. Trade wars can lead to price increases, with manufactured goods in particular becoming more expensive. This can then spark inflation. So that's really a big thing I'm talking about here, is if this sparks inflation again, then there again, we've kind of been talking previously, is that the Fed is kind of in their, they don't think that they need to hike or lower rates anymore for the time being. Essentially, inflation's kind of sticky right around that 2.93% in terms of the Fed's target. I'll show you over here. We'll flip over. I'm just looking at the true inflation. So if you haven't checked out this website, it's a really good website that kind of tracks more of the real-time inflation. So we see here the real-time U.S. inflation as per Trueflation here is 2.23%, so quite a bit below the government reported rate of 2.9%. That being said, just remember the Fed uses lagging data for their numbers, so they're always going to be a little bit behind kind of the current numbers. But we can see here, obviously, there's this huge drop-off in inflation here. We want to see that continuing to come back towards that 2% target that the Fed's aiming at. Again, though, the Fed's aiming for that government reported 2%, where true inflation is kind of that actual real time inflation rate measured from all sorts of different data available. But yeah, we can obviously see there. So we flip back over to our trade wars here. Yeah, so we see in early 2018, this is just prior examples, kind of recent examples. We see he threatened a substantial fine over alleged intellectual property theft and significant tariffs to China. And then China retaliated with a 25% tax on 100 U.S. products. Throughout 2018, the two nations continued to threaten each other, releasing lists of tariffs. China responded with lists of its own. American duties did have an impact on the Chinese economy, hurting manufacturers and causing a slowdown. Then we saw in December, each nation agreed to halt the imposition of any new taxes. The tariff war ceasefire continued into 2019, so a little bit of a relief period here where we were able to seize the kind of, and that's right around that COVID timing as well. So interesting to see there. Maybe they just backed off because all the economies were hurting so bad that they kind of just, had stopped threatening each other and just inject a bunch of money into the economy, really try to boost business again. See here, though, on May 5th, 2019, we saw the president doubled down, saying he was going to increase tariffs as of May 10th from 10 to 25% on $200 billion worth of Chinese imports. And then China halted all imports of farm products by state-owned firms in retaliation, leading to concerns about a currency war. So then kind of getting into that, we'll touch on that quickly. So you can kind of see how all of these things kind of lead into each other. Actually, the tariffs lead to a trade war, and the trade war can lead to a currency war. So we'll just touch on that quickly. We do see here a currency war is essentially a tit-for-tat policy of official currency devaluation aimed at improving each nation's foreign trade competitiveness at the expense of other nations. So again, they're just trying to attack each other's currency and make theirs a little bit more competitive. A currency devaluation is a deliberate move to reduce the purchasing power of a nation's own currency. Countries may pursue such a strategy to gain a competitive edge in global trade and reduce their sovereign debt burden. And then devaluation can have unintended consequences that are self-defeating. The worst of these is inflation. So that's what we're paying attention to. If inflation starts ticking back up, it's going to look really bad. The Fed essentially is going to be forced to probably hike rates again, depending how fast it starts going up. We have seen that inflation's a little sticky, as I mentioned, right around that 3%, 2.9% in terms of the government numbers. And then, so we just see they have no reason to cut rates further. The market is not pricing in any rate cuts. And then again, if we do see a kind of an uptick in inflation due to a global trade or currency war, then it's just going to further kind of let the Fed, they can either hike again if they need to, or again, they'll just stand firm, no more rate cuts. Even they might even get rid of the potential for one rate cut before the end of the year. It's all on the table essentially. We'll be following that as it goes and listen to kind of the Fed's rhetoric over the next meetings. See here too, again, during a currency war, the nation's consumers also bear the burden of higher prices on imports. So again, it's the consumer that hurts at the end of the day, not the businesses. So yeah, we're paying attention to that. Don't listen to what the politicians tell you. It's not going to be all sunshine and rainbows for all the consumers. They're not going to offset all the income taxes like he said. That's just not realistic to expect that. So really listening to what history is telling us as a result of these kind of economic events rather than what a politician is telling you at face value. And then in 2020, we see here they did realize it was mutually destructive, and the U.S. and China agreed to a trade deal that was signed in 2020. So again, it's kind of funny that they found it mutually destructive prior, and now he's just going and doing the exact same thing. It's almost like the definition of insanity is doing the same thing and expecting different results. So again, we'll see what happens here. But 2024, the U.S. continued raising trade barriers. Biden raised tariffs on EV vehicles 100%, as well as solar cells and semiconductors. Other technology products also faced sharp tariff increases, causing China to pledge further retaliation. So is the United States in a trade war with China? To break it down simply, yes. In 2024, the U.S. implemented extreme tariffs that some experts described as a trade war. And now with these further tariff increase from Trump, I would say definitely supporting that theory that we are in a potential trade war, or at least the beginning of a trade war. How far it escalates, nobody really knows, but we do have to be wary and cognizant of what's going on around us. I touched on the currency war there. We'll just flip over here. I want to show you kind of stock market returns on days with tariff announcements. So to people saying that this might not have an effect on markets, the data kind of says the opposite. So we see here, obviously, of all the times that tariffs were announced, here it was a little green here, barely, but we saw minus 1.1, minus 2.4, minus 1.9, minus, minus, positive, minus, 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 minus. So a cumulative score of minus 11.5. So essentially, during the days that they announced tariffs, the market typically went down. So we'll see what happens on Monday when the market opens if we see more volatility. That being said, we did see quite a red day on Friday there for the stock market. We'll take a look at that in a minute here, but we can also scroll down here. So one might be tempted to dismiss these declines as market overreactions. The data militates against the interpretation because the declines were persistent. The chart below shows the cumulative stock market return over a 10-day window around the tariff announcements. So you'll see there that the effect occurs entirely on the trading days corresponding to the announcements, indicating that the market did not anticipate these announcements and did not bounce back in the following week. So we see here down in this chart, this is that cumulative stock market return based on 10 days surrounding the announcements. So we see here right before the announcement, markets have essentially dumped out, and then we kind of find a low here, and then that's our new kind of baseline here. So we're watching that. We did see that dump in the stock market on Friday, so maybe that's what we see, and then we just normalize, maybe go through some consolidation, maybe have a bit more downwards pressure to go through, but just watching that, yeah, so interesting to note. The history says that these tariff announcements do have a direct effect on the stock market in a negative way. Just flipping over to a couple more kind of worrying economic factors. So obviously we looked at inflation. Although it looks good now, it is a little sticky. Just flipping to the U.S. Treasury spread. So I've showed this before. This essentially just shows you the Treasury spread between the 10-year and the 3-month U.S. Treasuries, as well as it's overlaid on the S&P. And then kind of you can see all the recessions shaded there. So you see when the Treasury kind of yield curve uninverts here, that's when we start to see these recessions start to form. So here, all through back to the 1960s, essentially these recessions have lined up with the uninversion of the yield curve. You see right here, we have uninverted, so the yield curve uninverted here. So yeah, interesting to watch. Generally, when this does uninvert, we do witness a potential recession in kind of not necessarily the near term. So I'm going to get into that as well. We'll flip over to kind of our days after uninversion. So the reason I look at this, essentially, this is a slightly different. We're looking at the 10-year and the 2-year, which also typically when they do uninvert shows a good representation of past recessions. So we see here, by the time the recession triggered, so by the time this gray box kind of really showed up, we did already come off the highs a little bit. You can see there, 44 days after uninversion is when this first recession triggered. You see here we had about 120 days after recession or after uninversion where the recession materialized, and we see here about 111, 105, kind of between 105 and 110 days after the uninversion, we saw a recession form here. So let's look over here. We saw obviously this little, it wasn't really an uninversion because we didn't invert. So, but we did see this bounce here and then the corresponding weakness in the S&P. You see just that little uptick right here really took us off those highs on a decent little retracement. And again, we didn't get into a recession. That was a recession scare, but no actual recession announced. That being said, that was quite a large stock market drop. So you can see here again, 56 days after uninversion. If we take an average of our recessions in the days after uninversion, we're kind of looking at about 85 days on average after the uninversion of this yield curve when we start to see a recession materialize. So if we go over here, we're right at 94 days after uninversion. So we're not quite at the higher end of some of these ones that were 105 to 110 days after uninversion, but you can see we're getting right around that average kind of timeline when a recession would materialize after the uninversion of this yield curve. So that's something we're just watching. Again, if we experience a global trade war, I think that could be essentially a narrative that follows the price and really pushes these markets down a little bit. There's enough worrying economic factors in the market, in my opinion. I think we're kind of stuck in this, we're in a bit of a kind of weird scenario here where we've got the top 1%. Essentially, they've got very high consumer confidence. And you can see in the S&P, basically, S&P is right near all-time highs. So the richest people in the world, they own all the assets, and all the assets are near all-time highs. You see gold at all-time highs. You see basically, yeah, you see gold, SPY. You see all the risk assets, essentially all tech stocks, all right near their all-time highs. Everything's at crazy valuations. So essentially, you've got them with really high consumer confidence, and then you've got everyone else in the lower income brackets and kind of the lower classes. They all kind of have lower consumer confidence because there's not as much savings right now. So consumer savings is low, mortgage delinquencies are going up, credit card delinquencies are going up, consumer savings is going down, wages are not keeping up with inflation the way they used to. Inflation's still pretty sticky, cost of livings are still really high. So you can see how the everyday consumer really is not kind of feeling the economic relief that the 1% are feeling up here because they own assets and their assets have been appreciating. Whereas if you're someone who can barely afford to eat, or maybe you can barely afford your rent as well as your food, you're supporting a family, you don't have excess capital to put into markets and you don't have excess capital to invest, that kind of thing. So you're just stuck there. Essentially, you just shoulder the down or the kind of negative burden of all this, while the richest people continue to see their net worth increase. So it is interesting to see, obviously, the SPY obviously at all-time highs. So yeah, I kind of think we're in a bit of a pseudo recession. That being said, by basically we would have been in a recession. They changed the definition. Basically, I think they're just kicking the can further and further down the street. I think the only thing holding us out of an official recession right now is the the employment data, which is holding relatively strong. That being said, you have to take in account that this employment data is somewhat kind of skewed. You often see a lot of government jobs kind of propping up the employment data, or you might see people having to take on multiple jobs, so it looks better on like paper, but in reality, it's people who are having to take multiple jobs. That's not indicative of a healthy economy. They might not be able to find full-time work, and therefore they have to take on multiple jobs. You have people coming out of retirement having to work because they can't afford the cost of living, and you've kind of just got savings going down as well as all these delinquencies on debt rising, and the cost of living is still ridiculously high. So you can see here, obviously, the richest people are doing great. They got all the assets. They had an additional $2 trillion worth of value kind of funneled to them through COVID. I'm not going to get too far into that, but essentially we printed all this money, and if you follow it, it essentially found its way into the richest companies who were charging excessive prices on the same cost of goods that we were all forced to buy. So just following that along, we do see here our momentum indicators of the SPY here. So we've got our RSI, we've got our DMI, and we've got our MACD. Kind of neutral setup on the DMI. Our MACD and our RSI are looking a little bearish here, kind of heading back towards what might be a bearish cross. You see the green histogram pretty much playing out here. We're probably going to come back, maybe flip into the red. So I want to take a look at the stock market. Obviously, we were talking about the previous kind of Japan carry trade. That's another implication that I still think should be a risk that we consider in the market. So we've got the potential for a trade war. We've got sticky inflation. We've got this huge divergence between consumer confidence of the upper and lower classes. We've got the Japan carry trade likely to continue being unwound over the coming months, especially kind of the Bank of Japan signaled that they are going to continue hiking rates if need be. So when we saw that, we saw this almost 10% correction back down here. So I pulled that for you to look at here. If we were to experience a similar 10% correction, that brings us down almost to the 618 Fibonacci level, a really nice level of support. I frequently target some buys in here. If we come back down here, I think that's a decent little position to buy into the SPY at 550 here. Generally, the S&P is just going to keep trending up and to the right. That being said, it can go into these times of downturn. If we go into an official recession, expect at least a 20+% drop in the SPY. So, we might see it come down kind of the 618 around here. That might be a good place to kind of start a bit of a position, start buying the SPY. And then if you see it come down down towards this 786 or lower, then that would be more of like really kind of start to accumulate the SPY if you can. This is going to be a higher risk level up here, kind of in the near term. Again, I can't predict exactly what the outcome of these events is going to be, so I'm just hedging myself for multiple scenarios. I have a cash position. If we come back to these levels in the SPY, I'm going to start buying and acquiring that cash position, hopefully position myself for the next leg up. Otherwise, alternatively, if we flip over to our low time frame here on the 4-hour, I'll show you here, just kind of breaking things down by the time frame here. So I'll just show you. We saw this uptrend here. We broke out of this downtrend. We back tested it, kind of came back here, held this. You saw this little swing trade. We came up right within our profit taking level here. We didn't quite hit it. That's when I talk about that margin of error. So yeah, if you're in this trade and you missed, that's like 0.15% away from your profit taking level, take profits. Like you're close enough where that's good enough. If at least you don't take profits, move your stop loss up. That's what I did. So I moved my stop loss up. Unfortunately, it hit. I'm out of that trade. I haven't lost anything, but we did manage to kind of catch that for the majority of that move. That being said, I should have followed my strategy of having that margin of error and just taking my profits because it was close enough. That being said, I just wasn't watching it close enough either, and it just came back. That's okay. I'm stopped out. I didn't lose anything. We tried, and then we just wait for the next setup. So we obviously want to see these lows hold for a chance to continue going up. We see a trend line rate coming through here. Yeah, so just like that. But you see, kind of breaking below it a little bit here. So we need to regain that trend line, and then maybe we can attack those all-time highs again. Otherwise, I've got this Fibonacci zone here. So pulling from this swing low to this swing high of the Fibonacci golden zone lines up here just under 590. So 590 on the SPY down to about 583 might be a decent little swing position. Otherwise, if we are able to hold these lows, put in another higher high and higher low, then we're likely to just continue the uptrend. We could break out, go a little bit higher. So that being said, we could actually see the S&P kind of break out, put in new all-time highs before we actually kind of see that potential breakdown in the macroeconomic side of things. So we're just watching that. We just follow the charts, and the charts right now are telling us that it's looking good or good enough right now. That being said, we'll flip over slightly to the dailies. I want to show you here. This is where we have this came up, kind of resistance, put in our top, lower high. So look at this massive bearish engulfing candle. So a really bearish candle right there, which kind of shows me that we're likely to come back here. We do see our bull market support band is starting to curl back over here. So kind of signals some sideways consolidation is likely to occur. We've pulled up our momentum indicators on our daily chart here again. Neutral DMI, kind of looking a little more bearish on the RSI and MACD. That's why I think we're likely we at least come back and test kind of these lower levels here. My most probable area of entry would be that 618786 Fibonacci golden zone. So just watching that for potential entry. But that's essentially all I wanted to cover today. Just kind of look at some of the implications of past trade wars, as well as kind of some risks of these new tariffs coming in. If you learned something new, you like the content, please like, share, subscribe. Leave a comment if you want to request any chart or request any kind of video. I want to do the content that you guys request and you guys want. So feel free in the comments, just request anything. I'm here for you guys. I want to teach you things. I want to help you be aware of what's going on in the markets, and I want to help us kind of create that strategy, remove the emotion, and then execute that strategy as price comes into our levels, and then reap the rewards when we see kind of that reversal to the upside. So that's all for today. Thank you guys for watching, and I'll see you in the next one. All right.